But if you remember, the Great Recession started in 2007. But I was doing interviews on popular shows in mid-2008, and they were saying there's no recession. So what happened was all these economists went backwards and revised down all the data, and then they said, okay, I guess we were in recession. They didn't even think a recession was coming. But the fact of the matter is we were actually in one at the time, and they couldn't even see that. And I think this is the same situation today. You know, we actually had negative quarters. The first 2 quarters were negative. The third quarter, in fact, you know, we got some numbers out on that today. I mean, it was up maybe 3% or so. But all of that was due to the improvement in the trade deficit during that quarter. And a lot of that resulted from the fact that we were able to export a lot of the oil that we were pulling out of the Strategic Petroleum Reserve. But we're going to exhaust that reserve sometime next year, so that's not going to be able to offset our trade deficits. But also we had the big rise in the dollar. Well, in the fourth quarter, we've had a big fall in the dollar. It hasn't lost all of its gains yet, but I think it will in 2023. But as the dollar weakens, that's also going to push up our trade deficits because it increases the cost of all of our imports. So I think the help that we got in Q3 was a one-off quarter. We may end up with a negative print for Q4, we'll see, but I think we're going to get quite a few negative prints in 2023 as more air comes out of this bubble. And then I think it's going to be very hard for the recession deniers to continue to put a positive spin on this economy. They're going to have to admit that we're in recession. The question is the Fed going to change course as a result of that admission, or is it going to continue with the rate hikes and quantitative tightening, making a bad situation worse, which is what it should do. But the question is, will it do that?
You mentioned the dollar weakening next year. Now, one of the reasons for a strong dollar this year was the spike in the short end of the curve because the Federal Reserve kept raising interest rates 7 times now, I believe. Peter, why do you think the dollar is going to weaken? Are you assuming the Fed's going to be less hawkish next year?
The real reason that the dollar rose was not just that rates rose, but that the markets believed that these rate hikes were going to work in that they were going to bring down the inflation rate. The Fed said that we're going to return inflation to 2%, and we're going to do whatever it takes to make that happen. And the markets basically took the Fed at its word. And so they bought the dollar on the idea that, these high rates were going to produce positive real returns for dollars. But I think as the markets come to terms with reality that despite the rate hikes, inflation is not going down to 2%. In fact, it's more likely to head higher after this, brief dip that we've had. And so that even though the Fed has raised rates are still negative from a real term. And if you have negative real interest rates, that is not a incentive to hold dollars. That's an incentive to sell dollars because the interest that you earn is not high enough to compensate you for the purchasing power that you lose. And so when investors figure this out, I think the dollar is going to fall sharply, and that's going to exacerbate the problem that the Fed is dealing with, because the strength of the dollar limited the rise in consumer prices in the United States in 2022. So even though prices were up a lot, they would have been up even more had the dollar not been strong relative to other currencies. Well, if the dollar really weakens in 2023, that's going to add additional upward pressure to already rising consumer prices.
It is very, I want to talk about inflation just a bit. It is kind of ironic that the dollar strengthened so much relative to other currencies while domestically inflation was at all-time highs. You would expect, inflation and the currency to be two sides of the same coin. Of the dollar, if inflation goes high, you would expect the currency to weaken. Well,
remember, all these countries were experiencing inflation. Most of the Eurozones, their inflation rates were higher than ours. I mean, they're still looking at, over 10% year-over-year inflation rates in many European countries. So all currencies were losing value. It's just that on a relative basis, it's like if I'm going backwards at 10 miles an hour and the car next to me is going backwards at 20 miles an hour, relative to the car going backwards at 20 miles an hour, I'm moving forwards. But I'm not moving forwards. In reality, I'm still going backwards. And so even though the dollar was strengthening, relative to the euro or the yen, it was still losing value in real terms. Just it was losing value more slowly than the euro or the yen. I think the difference in 2023 is we're going to lose value more rapidly. So the euro and the yen will continue to lose value, but the dollar will go from losing value slower to losing value faster.
You mentioned that inflation will probably tick back up in 2023. Let's talk about that. So in the last 6 months, CPI has peaked at 9.1. Well, headline CPI peaked at 9.1% in June, and it's been slowly ticking down ever since. We're now in the sevens. Let's talk about that first before we talk about the future. What happened over the last 6 months? Why did we get an increase, or decrease rather, in the CPI print?
Well, some of it was the strong dollar, and so that reduced our import prices. Also, we had a correction in energy, oil in particular, and so that helped take some of the sting out of the CPI. Other commodities also pulled back. So on the headline number, we got some relief, but of course on the core, not so much. A lot of the prices continued to rise even as some of the headline numbers were coming down. But also remember, prices continue to go up. It's not like they're coming down. They're just going up a little more slowly than they were going up before. But if prices were too high, even a little increase is still a problem. What we need is for prices to go down. We need to, for prices to recover, or for consumers to recover some of their lost purchasing power by having consumer prices actually fall. But that ain't gonna happen.
Right.
All we can hope for is that they rise more slowly. In fact, that's what the Fed's goal is. The Fed's goal isn't to reduce prices. The Fed's saying that we're hoping to reduce the annual increase to 2%. But those 2% increases are gonna come on top of all the increases that preceded them. So if prices go up, I think over the last 2 years, they're up better than 15%, even the way the government measures them. In reality, they're probably up closer to 30%. But even if they start going up 2% from here, we're going up 2% from a much higher level, than we were at before. But of course, we're not going down to 2%.